yesterday I have shared one set of questions on module A. Two more series are there in the, along with practicing the mock test of the entire paper, you can look into this module-wise test also. So you will get an idea how the questions will be asked in the examination. Similar questions they may be asking, because we have set the questions based on the previous exams conducted by IABF. We don't get the question paper, we are getting the feedback from the candidates, and based on the feedback, we have prepared this. The basic thing is you have to understand the concept. That's the thing. You need not by heart any question. You have to understand the concept well. And if the concept is clear, there is a clear conceptual clarity, then you can easily answer the questions. So the options you have to look into. The options may look alike, maybe with a small difference. So first you have to eliminate. One or two you can straight away eliminate, and you may have a doubt between the two options. So you have to choose the correct and most appropriate answer. So that is the way in which you have to answer. If the concepts are clear, I don't think there will be any difficulty. So read and read, revise frequently. So what you have learned in the first session, you may be forgetting. So try to recollect, try to revise it as and when you get some time. So time management is again very, very important as far as the exam is concerned. Even in the examination hall, time management is very important. Not only that, for preparation also you have to manage the time. You have to prioritize. What are the things you have to give the first priority? So like that, you prioritize your job, your official assignment, as well as your family and social commitments. Now concentrate on the examination. That is the only aim before you now. Clear the exam in this May, June. So please learn the entire topic. Say ABCD 4 modules in each paper. So you may think I need only 50% mark. I don't want a distinction on other things. So 100 mark question, 50% ABCD, I will prepare for 2 modules A and B. You may not be able to clear it. So you have to read and understand the concepts of all the 4 modules. And you can, some topic you can give less importance if it is not digesting to you. You are finding it very, very difficult. Don't spend much time on that. You give scant attention to such areas. But I recommend you have to learn the entire topic. So it's already time is out. Shall I start? We are moving to Treasury Management, the C module of BFM. In the first session, I'll be touching upon the basics in Treasury Management, and then we will move on to other aspects. Unit number 19 of your text as well as study material we are going to cover in this session. So first we start with the definition of treasury management. The word treasury refers to the asset or the holding, the valuables of any organization. So treasury management means management of the assets or management of the holdings or management of the treasures of a person or an entity, and to our context, it is in the context of a bank. So what is treasury management as far as a bank is concerned? This is the definition or the meaning. It's a management of the financial assets and holdings of any organization, and as far as we are concerned, of a bank. And how this is to be managed with the ultimate objective of maximizing the profits or maximizing the return on investment. Therefore, the objective of a bank is to increase the profitability or to maximize the profitability. So with minimum risk, with managing the liquidity and mitigating its operational risk, financial risk, and reputational risk, so as to maximize the profit. So, or maximize the return on investment. This is what, in one sentence, if I say what is meant by treasury management. Now we talk of, when we talk of treasury or the treasury management or the department of treasury in a bank, you have to segregate into two era on the after 1990 and on prior to 1990. So what's the implication, or what is the importance of this 1990? Because it was the year during 1990, economic reforms started in India. Economic reforms refers to the LPG regime. LPG stands for liberalization, privatization, and globalization. So this LPG regime commenced in India, or a lot of changes have taken place in the Indian financial sector, Indian banking sector, or in the Indian economic field. Because of this regime, liberalization, a lot of liberalization has taken place. Privatization, given importance for privatizing so many industries or so many operations, and then globalization from the indigenous market, that means from the domestic market, we were thinking of considering the entire world as the market and area of operation. So that is the meaning of LPG regime, liberalization, privatization, and globalization. This took place in India during 90s when Manmohan Singh, he was the finance minister. After the retirement from Reserve Bank governor, he became the finance minister, and he has brought in this particular reform in economic reform in India. And before the changes in the economic sector, or before introduction of this LPG regime, the function of treasury, we call it a conventional treasury. And the functions of the conventional treasury, it was ultimately managing the funds, or you can say managing the liquidity. So these are all the four functions, all connected with funds management. One is funds management, you can say. So any bank, if they want to function, they need cash. And some situations, there may be shortage of cash. And sometimes there will be a surplus of cash with a bank. We call it the liquidity position. So if there is a surplus of cash, they have to invest it profitably, because from where a bank gets cash? From the depositors. So they are creating liability. The bank is accepting deposit from the public, and they have the capital, their own capital, and this amount they have to invest. So at some point of time, there may be a surplus of liquidity. A lot of deposit will come. So the bank will have surplus liquidity. There is no avenue for deployment. That means for granting loans. So in that case, there may be some surplus, and this surplus, they cannot keep it idle. They have to invest, because the fund which the public are depositing, they need interest. Like other than current account, in all other deposit, you have to pay interest of various rates. Savings bank lesser rate, fixed deposit a higher rate. Therefore, you have to invest the surplus cash with some profitable investment areas. That means we call it security. So the security here means it's not the collateral security or prime security which a bank look for while granting an advance. Here the security means it's the investment, bond, debenture. All this we call in one sentence as a security. Therefore, it has to be invested in some security and get a return, so that the fund is not lying idle. That is one situation. In the second situation, there can be a shortage, because a particular bank or bank in the entire sector, there is a shortage of deposit. The public doesn't have much cash, because the public, if they have surplus, then only they will deposit. So there is a shortage of liquidity in the market. So banks are not getting deposits. So in that case, what the bank has to do? Bank has to find some other way to create liquidity and grant the loans. In that case, they have to borrow. So in the case of surplus, they have to invest. In the case of shortage, they have to borrow it from some source, either from Reserve Bank or from, we have seen from foreign country, like that they have to borrow. So this is the prime objective of the treasury during the 1990s. That is called maintenance of cash balance to meet day-to-day requirement. That is the funds management. Apart from that, when a bank is functioning, looking at concentrating on the liquidity, they have to maintain reserve ratios. What are the reserve ratios? It is CRR and SLR. CRR stands for cash reserve ratio. SLR stands for statutory liquidity ratio. So cash, we will learn about these things later during the treasury management in detail. On topic, on a session is exclusively for reserve ratio maintenance, liquidity, and other things. So therefore, as per the directions or the regulations or the guidelines of 2 Act, as far as a bank is concerned, we are more concerned about 2 Act. There are a lot of other acts. The 2 Act, one is RB Act, another is BRA, Banking Regulation Act. So based on this Reserve Bank of India Act, each bank has to maintain certain percent of their DTL in cash with Reserve Bank, that is CRR. And as for Banking Regulation Act, they have to maintain certain amount, say as of now it is 18% of the DTL in approved securities. They cannot deposit that money in Tata Motors bond or bond issued by or debenture issued by Reliance Industries. No, Reserve Bank from time to time they list out the approved securities, or I can say in short, approved security is government securities, government bond, treasury bill, and other state development bond. These are all the eligible securities ranking for SLR calculation. So that was the lookout of treasury to maintain the adequate ratio, 3 and 18% as of now. Apart from that, the management of risk, that is, they already told you, while managing the asset, they have to look at the risk, the operational risk, the business risk, all those things, all the risk they have to look into, a transaction risk, and then they have to mitigate the financial, operational, and reputational risk. And next job of or function of treasury is ALM, asset liability management. Because any bank, they will have asset, they will have liability. So managing the assets and liability is also an important aspect. Here, how the assets and liabilities managed, that means it is the pricing of the product. What is in by pricing of a product? Pricing of a product refers to fixing the interest. When a bank is accepting deposit from the public, they have to pay interest. So how much interest is to be paid for the deposit? Similarly, when a bank is granting a loan to a customer, what is the loan interest rate to be charged for the loan? So this is called the pricing of the product. We have various products as far as the bank is concerned. Look at the credit. They have a vehicle loan. They have education loan, housing loan, term loan, business loan, agriculture loan. So many different products are there, and each product will be carrying a different interest rate. So depending upon the market situation and depending upon the cost of fund, each bank will be fixing the interest on their advance. That is why the interest rate of housing loan for State Bank of India may be different from that of Union Bank or PNB. Maybe slight variation. 0.25%, 0.5% variation will be there, because it depends on how the treasury of that particular bank fix the interest rate, depending upon based on the cost of fund. So that is product pricing and strategic investment. So pricing of the product, you have an idea. What is the interest to be charged for a deposit or for an advance? That is called the pricing. And in addition to that, suppose they have met the requirement of the customers, they have deployed, still they have some surplus amount. So that has to be invested strategically. That is called a strategic investment. They have investment, various opportunities are there. Suppose you have 1 lakh or 10 lakh with you, you have various opportunities. You can play it in the stock market, you can invest in gold, you can deposit in a bank, you can deposit in an NBFC, you can give to a private money lender. Each will carry some risk, or you can invest in a landed property. So these are the various avenues where you can invest. So some investment may fetch you a higher return, but some investment may fetch you a lower return. So the relation here is higher the risk. If you're taking more risk, will get more return. That's a logic. Suppose you want to get more return, then you have to take higher risk. You can, if you lend money, you deposit money to a private money lender, he may offer you 12% or 15%. But the stake, you are running a risk. You are facing a risk, because the money lender at any point of time he can fail. Then the entire principle will be out. But you deposit in a public sector bank, it is more safe, but you get a lesser interest. That is why the return and risk are directly proportional. If you are willing to take higher risk, you will get a higher return. If you doesn't want, you are not prepared to take a higher risk, you doesn't want carry a higher risk, you will deposit in a bank or in some other institution where there is no risk. So these things, the management or the people post the treasury, they have to decide. That is called product pricing and strategic investment. And before the introduction of the LPG regime, the objective or the intention, or they are looking, the treasury is looking, or they are working, acting as a service center. So they are not looking at the profitability angle. They are not giving more thrust on the profitability. Instead, they wanted to render the service to the customer and to the branches. So the treasury, the conventional treasury, was acting as a service center. Now, during 90s, when the LPG regime introduced, the role of treasury or the objective of treasury has been changed, and we call it an integrated treasury. So there is a shift from conventional treasury to integrated treasury. And in integrated treasury, the three departments have been merged together. So here I told you, it's a direct result of the economic reforms in India during 90s. So economic reforms refers to the LPG regime. And because of this LPG regime, this liberalization, privatization, globalization, the Indian banks or the financial sector in India, they were looking globally. What is happening in other countries? We look at the developed nations like European country, US, UK, all these countries, how they were doing the business and restricting the flow of fund, regulating the foreign exchange transactions. They are looking at that. And the deregulation of interest, this is the first step, has been introduced in the banking sector. The interest rate has been deregulated. What is the meaning of this? Deregulation of interest rate means prior to the economic reforms, or prior to 1990, it was the Reserve Bank of India which fixes the interest rate for both deposit and advances. That has been deregulated. So the regulation imposed by Reserve Bank of India, they have removed it. Now it is left to the banks. Banks can fix the interest rate for the deposit as well as for the advances. That is why Yes Bank, like Yes Bank, they are offering 6% or 7% for their savings bank account. So each bank, depending upon the requirement and the business opportunity, they quote a different interest rate for both deposit and advance. That is number one, deregulation of interest rate. Number two is the partial convertibility of Indian rupee. Prior to the economic reform, there were a lot of restrictions in moving fund from India to out, or taking fund from a foreign country to India. A lot of regulations. It is not totally banned, but a lot of restrictions were there. That has been liberalized. And we have seen one scheme called the LRS that has been introduced in the year 2004. In foreign exchange, we have learned, isn't it? In 2004, the LRS regime has come, or you can say LRS has been introduced. That means any resident Indian, they can, for specific purposes, both for capital and current account, they can take foreign exchange money from India to a foreign country. That is called liberalized remittance scheme. That has been brought in. That has been brought in by Reserve Bank of India as a part of this economic reforms or LPG regime. So here, what is partial convertibility? The Indian rupee is partially convertible. Convertibility means the freeness with which you can move fund from India to a foreign country or a foreign country to India. Look, US dollar, it's a freely convertible currency. We have seen so many times in international bank in A module, freely convertible. What is freely convertible? There is no restriction. Any amount, any quantity of amount can be brought into that country. Similarly, it can be taken out of the country. This is not the case with India. All developed country, the currency is freely convertible, but Indian rupee, it is partially convertible. Partially convertible means there are certain restrictions for movement. In the current account aspect, we have seen the Forex transaction, you can divide into two. One is current account, another is capital account. If it is for investment, there are certain areas I have mentioned in IB. Here also I'll be explaining. Certain transaction you can classify under capital account. If a particular transaction is not capital, it will be a current account transaction. So as far as the current account transactions are concerned, the restrictions are less, or you can say it is freely convertible. But coming to the capital account transaction, a lot of restrictions are there in India. That is the meaning of partial convertibility. So this has been introduced after the introduction of LPG regime in India. So after 1990, Indian rupee became partially convertible. Next, a lot of relaxation has come in these areas. What are the areas? One is FDI. FDI stands for Foreign Direct Investment. If a foreign entity or a foreigner, they want to invest directly in India, That is called a foreign. They want to set up a factory. They want to set up a business unit in India, production, manufacturing unit. Then it is a foreign direct investment by an American company or a German company is starting an automobile shop, automobile manufacturing unit in India. It is a foreign direct investment. Or ODI, overseas direct investment. In Indian corporates or HNI, high net worth individuals, they can invest outside India. That is called overseas direct investment. Relaxation, subject to certain conditions, it can be. It's not freely converted. Next is ECB. We have seen yesterday, external commercial borrowing. When an entity in India, for doing their business, if they want a fund, they are running shortage of fund, they can borrow outside India, subject to certain conditions. So relaxations in that. Then FC operations of resident Indians. A resident Indian, you may think, as far as a resident is concerned, why should he need foreign currency? He can. He can book forward contract. He can do transactions in foreign currency, subject to certain restrictions. That is FC operations of resident Indian. So these are the relaxations introduced by Reserve Bank of India after the economic reforms during 90s. And because of these changes, the three departments earlier working in separate offices. One is the money market transactions, departments dealing in money market, then in security market and in Forex market. All the three has been merged together and they formed the Integrated Treasury. So what is Integrated Treasury? This is the combination, or you can say the integration of the three market or the three department. One is the money market, the department which handle instruments. Next, the security market, the department which engage or do transaction in securities. Then foreign exchange market. Foreign exchange market is familiar to you. The other two money market products we are going to learn in the next class. Therefore, all the three departments has been merged together, integrated together, and that is called the Integrated Treasury. And now the objective of the Integrated Treasury is to maximize the profit. So the shift from conventional treasury to Integrated Treasury, the function or the objective also has been shifted from service center to profit center. Now the treasury, or I'll say only treasury. Treasury is looking out how to maximize the profit, how to make profit. So the ultimate aim of a person posted at the treasury is to maximize the profit. That is why the shift from service center to profit. Earlier, it was rendering service to the customer. Now that concept is there. Rendering service to the customer, it is there. In addition to that, the treasury is operating to maximize the profit. And this is the two treasury, conventional treasury and integrated treasury. Now we'll move on to convertibility. This already I have explained in IB, the current account and capital account. I'll repeat once again, what is a capital account? And if a transaction is not a capital, it will be a current account transaction. To understand the concept, you have to divide it into two categories. One is a resident. Next, a non-resident. When I say a non-resident means it is not only NRI, it can be a foreigner also. Resident, I need not explain, a person residing in India. Now here, look at a person residing in India. When a person is residing in India, he is putting through a transaction. And when he does the particular transaction, there is a change. There is a variation. A change I put with plus or minus. Plus means there is an increase in the asset or liability or contingent liability where abroad. Therefore, look, when a person residing in India, if he is putting through a particular Forex transaction, and because of this particular transaction, there is a variation or there is a change in the asset or in the liability or in the contingent liability of this person where outside India. Look, a person A or an entity, a company, they are taking a loan from Japan. So they are creating a liability outside India in a foreign country. So much liability is increased. It's a variation. It's a capital account. Or suppose this company, L&T, they have taken the loan, they have repaid a portion. So there is again a variation. It was 10 crore or $1 million, they have repaid $5 lakh. So it has reduced. So variation. Or they have invested. They have taken a loan, that's a liability variation. Suppose a company is setting up a unit in Japan or in Germany. So by increasing the asset, or they are withdrawing the money, it against the variation. Or their contingent liability, and as of now, it's not a liability. It may become a liability on a later date. So that's called a contingent liability. Therefore, as far as the resident is concerned, if there is a variation in his asset or in his liability or in his contingent liability outside India, it is a capital account transaction. So I'll give an example. I've given an example for capital account. Look, a person residing in India, he had taken a loan of 1 crore from India, from a bank in India or from a financial institution in India. He has taken a loan of 1 crore. Is it a current capital account transaction? No, because there is a variation in his asset in India. It is not a Forex transaction. Or this person has taken a loan from India. In India, is a person residing in India, he had created a loan in India or a contingent liability. It is not a capital account transaction. So the change should happen outside India. Now look, the second category, it is a non-resident. Means a person not residing in India, that is called a non-resident. Don't get confused with NRI and non-resident. When I say non-resident, this refers to a person not residing in India. Person not residing in India may be an Indian citizen or a person of Indian origin, or it can be a foreigner. Both. Therefore, whether it is an NRI or a foreigner, we call him as a non-resident. A non-resident entity or a non-resident Indian, if there is a variation, means increase or decrease in asset or in liability or contingent liability, where? In India. So an American or an NRI working in Japan, he is taking a loan from India. There is a change in his liability. Or he is investing some money in India, depositing money in India. There is a change in his liability. Or he is creating a contingent liability. That is a capital account transaction. So I think you have some idea about which is current account, which is capital account. Now, what is current account? You put a transaction, look at a transaction. If it is not capital, it will be a Forex transaction, which is not capital. We call it is a current account transaction. So in my slide, I have given you some examples. You can just go through it. And now we're coming to the convertibility. Convertibility, as far in respect of current account transaction, you can say it is almost fully convertible. The restrictions are very low. That is why it's a free flow and outflow fund for the purpose of investment. For purpose other than investment is called the current account convertibility. Now coming to the capital account convertibility, there are a lot of restrictions. So if a person wanted to invest outside India or an outsider, a non-resident wanted to invest in India, there are certain restrictions. And that is why we call the capital account is partially convertible. Some restrictions are there, subject to the FEMA guidelines and other regulations. The cap for each investment is there. Maximum they can invest. And therefore, capital account is partially convertible, or put together, you can say Indian rupee is partially convertible. We'll move on to Integrated Treasury, the functions. These are all the functions meeting the reserve ratios, that is CRR and SLR. Already it is there for the conventional treasury. Then global cash management. In the earlier situation, it was indigenous cash management or management of Indian rupee only. Now the area of operation is the entire world. So therefore, each currency they have to maintain. That is what we call global cash management. Not only Indian rupee cash inflow and outflow, foreign currency management also the treasury has to look into. That is what global cash management, management of cash, both Indian rupee and foreign currency. Next is efficient merchant service. What is merchant service? Merchant service means the transaction which a bank does at the request of the customer. That is a merchant transaction. And an exporter or an importer or a traveler or a foreigner is coming to you, giving some foreign exchange, or they are demanding foreign exchange from you. You are acting at the request of the customer. That is called a merchant transaction. So efficient merchant transaction, because competition is there between the banks. State Bank of India may offer a better rate than PNB to grab the business. Therefore, efficient offering the best service, efficient service, merchant service. That is another function. Then optimizing profit in trading operations. That is called the proprietary transaction or trading transaction. There is no request from the customer. There is no request for buying or selling security or foreign currency or borrowing and lending money. But even then, the treasury is going to the market and to the forex market, to the security market, to the money market, and doing the operations. The purpose is to make the profit. And for maximize the profit, and in ordinary market, forex market, money market, and security market, here comes the interest arbitrage. We'll discuss about some example how to create profit, how to make profit by a treasury in doing a transaction, a proprietary transaction in this market. And next is risk management. This is another, they have to manage the risk, and ALM, assisting bank in managing the asset liability management. So these are the functions of integrated treasury. Again, integrated treasury is playing different roles, distinct roles. One is the liquidity management of liquidity, the funds management, and maintains the reserve ratio, that is the liquidity management. Then proprietary position, they are doing the trading transaction without the request of the customer. The treasury people are going to the market in all the three markets, security, forex, and money market, and they do the transactions with the objective of making a profit. That is called trading transactions or proprietary position. Next is managing the risk, bridging the asset liability mismatch, provide the derivatives to clients to manage the business risk. And because of these distinct roles, each treasury, the integrated treasury, has to maintain three different books. One is the ALM book, the internal risk management or liquidity management. So any transaction which a bank is doing for managing their balance sheet, managing the risk of their balance sheet, that is called internal risk management. They have to put those transactions, enter those transactions in the ALM book. Next is the merchant book, all customer-related transactions. When a customer is coming to the bank and requesting, give me $1 million, or another customer is coming to you, I'll give you $1 lakh or €1 lakh, you take. We buy and we sell. So such situations, all those transactions will be entered in the merchant book. So all client-related currency and derivative and security transaction will be entered in the merchant book. Next is the trading book. That means all proprietary transaction or transaction which are not related to the customer. Or you can say the transactions a treasury is doing for making profit.